Howdy, Jacob here. Today we're looking at Clearwater Paper Corporation in the paper and forest products industry. 873 million market cap on 1.3 billion enterprise value. Does look like they have a tad of net debt here. For sub-billion dollar companies, if I remember, I always like to look at insider ownership quickly. So 2.5%, nothing fantastic. Not a whole lot of management and board members owning the company, but not terrible as well. So they manufacture and supply bleached paperboards and consumer and paper rolled tissue, U.S. and internationally. Incorporated in 2005. I wonder if that's true. Growth is very flat. Revenue 1.97 billion to 2.08. So you're looking at 1% a year revenue growth. Pretty abysmal. Gross margin, nothing to brag home about. 10 to 15% with an operating margin in the 5 to 7 range. Return on invested capital also averaging mid-single digits, but it does seem to be pretty volatile in making money or not, which from these operating margins is interesting. So maybe it's just a lot of debt, making their interest payments kind of high. Okay, and then there's some other non-operating expenses as well. So free cash flow should tell a better story here. But let's look at that balance sheet first. So 42 million cash-like products, 460 million long-term debt, 1 million in short-term debt. So that 460 million long-term debt is not a terrible amount of free cash flow. I mean, if they can consistently get 180 million, then that's just over 2 years. But even still, you average the last 4 years or so, I think that the debt is not a terrible concern of mine, especially because they've been purchasing more debt than issuing debt for the last 4 years. And so at this rate, we're definitely comfortable with that. However, it's going to get to a point. This is not a bad thing, but it's just going to get to a point where debt is taken out and we don't necessarily know what they're going to do with the capital allocation. Because right now, the last 7 years, the only things that they've done are buy back debt, issue or repurchase a tiny bit of shares, and that's it. So once they have no debt, it's a great story, but what are they going to do? Are they going to strategically make acquisitions? Are they going to just repurchase a buttload of shares? We don't know that right now. And so with the next 7 years assumptions, I think there's enough debt for me to make a reasonable assumption that it won't be necessarily entirely cleared out by then. But let's get to it. So on the revenue growth side, probably looking at a 1% a year. And for a business growing at 1% a year, even with inflation, probably in the 2 to 3%, probably not the most impressive side there. So I think a P of 11 makes sense to me. For margins, I love that free cash flow is quite a bit higher. Maybe let's do 3.5 to 5%, a pretty big range for how small of margins we're talking about. But I think it seems pretty reasonable to me. I'm pretty comfortable with that free cash flow number just because, we saw their non-interest expenses were pretty high, so they maybe just selling off some goodwill or writing off some goodwill, which they haven't made any acquisitions for the last 7 years, and so it's not necessarily something that we need to expect going into the future. And the free cash flow margins are a bit more consistent, a bit higher. So then on the share change side, I really don't think they'll offset stock-based compensation for the next couple of years. I think they can. 1% is only $9 million. So if they wanted to buy back 1% of shares, $20 million. That's pretty abysmal compared to their free cash flow. So I might actually say that seems pretty reasonable to me. Maybe, a good amount of debt repurchase going on or debt pay down, but otherwise some share repurchases, some organic growth, maybe bump this up to 2%, saying that, they reinvest a little bit back in themselves, because I don't want this will have about, maybe 20 to 25% to reinvesting, making acquisition, 25% to share purchases, and then 50% to debt pay down. Again, you got to balance out what you want them to do with what they've done historically. I think that that's a reasonable assumption for me. And the company's stock price needs to fall 54% before you get the return I'm looking for here. So I will be sitting patient, looking at other companies in the meantime. And I hope you enjoy the video and have a great rest of your day. Thank you.